Well, first, thanks to EOC, Joanna, Karina, Rachel. This has been a fantastic event so far, and really pleased to be here, and hopefully we can keep the energy going with this session. It may be a little bit technical, but really important. And so, the other thing I'll just ask for is please engage with us during this conversation. Q&A at any point. We want to be here to help you as much as possible with the financing side of this. So as John mentioned, my name is Taylor Sekhon. I'm the Managing Director of Employee Ownership at BMO. And we've got a fairly ambitious plan for today, and that's to cover all of the financing solutions that are available for all of the models for employee ownership. And so wish us luck, but I think we got a shot at doing this. And so to help me in that, we've got three leaders from our local market here representing our commercial bank, our capital partners team, our private wealth team. And so I'm just going to let them each introduce themselves first to start. We'll begin with you, Devin.
Perfect. So I'm Devin Saylor. I've been a director with BMO's corporate finance team for the last 9 years. I work with a variety of clients in diversified industries across the prairies, so Alberta, Saskatchewan, and Manitoba. So thank you. Look forward to being here.
My name is Hans Jin. I'm with BMO Capital Partners, leading Western Canada. We're a $2 billion pool of capital on behalf of the bank, investing into a number of different situations, different industries.
My name is Dennis O'Dwyer. I'm a director and assistant market lead with Bank Montreal Private Wealth. I've been with the bank for about 17 years in multiple different departments, so I have a little bit of exposure to everything.
And I'll just add that Dennis has the good fortune of having worked on both the private wealth side and the commercial banking side, and so brings a range of perspectives there. So just for some context up front, at BMO, we're really here to support all models for employee ownership, stock option plans, share purchase plans, or ESOPs, co-ops, EOTs, all of it, right? And we generally think about employee ownership not so much as with the structure first, but with the application. And when our clients come to us about employee ownership, there's generally two applications they come to us for. One is either looking at employee ownership as a succession plan when they're thinking about an exit, or looking at employee ownership as a talent management strategy, a way to attract, retain, and sort of align the workforce around ownership. And so the good news is really, regardless of which structure you go with, a lot of the financing products are the same, right? And they all serve one common goal, which is to accelerate the transition to employee ownership in a really accessible way. It ensures that even if people don't have money, they can become owners in the business. And so that context I would keep up front in framing on why we use financing. So to start with, we're going to get into senior term loans, which is usually at the top of the capital structure. It's the most affordable, it's the most secure. And Devin, it'd be great if you could start by sharing a bit more about what senior term loans are, how they work, and some of the details.
Perfect. Thanks for that, Taylor. So really, term loans play a very important part in the capital structure of any sale to a business. They work alongside solutions that my colleagues will talk about today, but really with any business sale, a term loan from a senior debt perspective is going to play the largest amount in the capital structure. So really, unlike when a business owner is looking to finance any traditional fixed asset, such as a building that they may look to purchase or some equipment that they're looking to buy, where the lender is going to have that fixed asset to be able to fall back on. When we're looking at financing a sale to EOTs or really any other third party, we don't have that. And so we really need to understand the stability and the reliability and the maintenance of the cash flow of that business, because ultimately that is the security that the bank has to rely on. And we really need to understand that both on a historical as well as a go-forward basis. So typically when we're looking at structuring any types of term loans for a business sale, there's a few key points that we'll look to structure it. The first point is going to be amortization of these loans. So typically for sales of business, we're going to look at amortizations in the 7-year range with principal and interest payments monthly. In addition to that, pricing, although flexible, is going to be typically in the range of prime plus 1 to prime plus 2. However, there's an important point that I want to make, and that's really going back to that previous statement that I'd made around the reliability and the maintainability of that cash flow. When we're, as a lender, looking at businesses that have strong and maintainable cash flow and are in business sectors that are stable with strong management teams, we can look to have some flexibility with respect to that. And by flexibility, I mean There are opportunities for us to stretch that amortization up to 10 years, to reduce that annual debt obligation that the borrowers will have, as well as sharpening of pricing maybe in that 25 basis point range. However, the opposite of that is also true. If we have businesses that we're looking at that have wonky cash flows, some difficult years, and are potentially in an industry with a lot of ups and downs, we'll look to be a little bit more conservative in the structures that we outlay.
Perfect, thanks. And maybe just to emphasize the point there for a second, with term loans, generally speaking, there's some flexibility, but it's going to be more structured than other products, right? You're going to have payments to make according to your amortization schedule. You're going to have some restrictions on what you can do, but in exchange, what you get for that is, better pricing. It's often the cheapest form of capital that you can get, right? And so maybe to add a little bit more to this, could you talk about how the bank will typically think about loan sizing? So how much can a company borrow in a transaction?
Yeah, absolutely. So we really sit down with business owners and their teams to really gain a deep understanding of their business and its financial health. So a few pieces that we're going to look at is, obviously we're going to take a look at the income statement to assess profitability. We're going to take a look at that balance sheet to understand leverage and equity. And we're going to take a look at that cash flow statement to understand liquidity and how that cash conversion cycle works. So typically in the context of employee ownership, there's going to be two key points that we look at. We're going to take a look at what is that maintainable EBITDA, and we're going to apply leverage or a multiple against that EBITDA. And typically that's going to be in the range of 2.5 times to 3.5 times. So if you've got a business that's generating $5 million in EBITDA, we're typically going to be looking at structuring term debt in that range of $12.5 to $17.5 million in EBITDA. The second piece that we're going to take a look at is that what is that maintainable free cash flow of the business? So that's going to be your EBITDA, less cash taxes, less distributions, less CapEx, and then we're going to compare that to what the annual debt obligations are, so principal and interest, and look to apply a 15 to 25% buffer there, just to make sure that the business does have some ability to flex and some ability to continue to invest.
Perfect. And maybe just to touch on that last point a little further, often term loans will come with some restrictions around those other payments, what you can put into CapEx, what you can put into new investments, distributions made to shareholders. How does that typically work? What kind of restrictions will you see?
Yeah, absolutely. So to speak frankly, the payments to senior debt, because of that low cost of capital and some of the flexibility that we can provide, those payments do need to take priority over some of the investments and distributions that Taylor talked about. And so that's why it's really important that we sit down, understand what the ongoing investment needs of the business are, what the capital needs are on a go-forward basis. So really we can outline a structure at the outset that not only works for the business and its employees today, but on a go-forward basis. So, as an example, you may have a manufacturing business with a significant level of CapEx. And if we compare that to a professional services business with a very low level of CapEx, even at the same level of net income, the professional services business is going to have a significantly higher level of free cash flow. And really the most important part to note on that is that net income and EBITDA do not repay our loans. It's free cash flow that does. And so that's why we really need to emphasize that.
Perfect, thank you. So, often in employee ownership transactions, we find business owners are looking for liquidity above and beyond what you can get in a term loan. And that's where Hans's team will typically come in, where they can look at providing mezzanine. And so maybe we'll start with mezzanine financing. Hans, could you give us an overview of what that is, how that works, how that's structured, and how it compares to the term loans that Devin's been describing?
Yeah, so just as a primer on mezzanine financing, this is a hybrid instrument that finances between senior lender, which is a traditional loan, and an equity. And so it oftentimes would be ranking from a security perspective behind a senior lender, but it's still going to be ranking ahead of any equity holders. Oftentimes it's used for transformative events in a company's life cycle. So these could be shareholder changes, it could be major capital expenditures. It's not meant as much for the day-to-day working capital needs of the business. And so it's really a tool that allows business owners and entrepreneurs to get additional capital if senior lenders have reached the max of their comfort zone, but also don't want to necessarily dilute the shareholder base. And so this is a tool that can help get that completed. Yeah.
This is, as we move into the riskier parts of the, like further down the capital structure, that's where you see more flexibility on how the payment terms work, right? And so maybe if you speak a little bit more to what's the structure, how are payments determined? And I'm going to put you on the spot and say, what's the pricing?
Yeah, so it's a lot more flexible than senior lenders. The general philosophy for senior lenders is they want to de-risk as quick as possible, which is what Devin spoke on. With mezz financing, it's patient capital. And so oftentimes, I won't say for all mezz lenders, but for ourselves, we're not looking for any principal repayment. We're actually looking for it to sit out there, help the business owner grow, and after a few years' time, just repay it all in one shot. And so there's a lot of flexibility from that perspective. Even in terms of how the interest is structured, it can be cash payments, it could be capitalized interest payments as well. Really just a bespoke offering dependent on what's needed by the business owner. To answer Taylor's question, in this environment, what we're seeing from a pricing perspective is it ranges anywhere between 10 to 14%. But there is a lot of different ways to manage around that pricing. And so, as an example, we've seen deals where the borrower might have a desire to have lower pricing, and so what we'll do instead is we'll structure in perhaps some warrants or some equity features. So we all share in the upside if things go well. We all share in the downside if things don't go as well. We can also structure royalty features as well. So maybe a percentage of sales or a percentage of EBITDA. And that helps bring down the cost of the loan itself.
Perfect, thank you. So in a past life, I used to work on providing mezzanine financing to employee ownership transactions in the US. And one of the things we often heard back was, whoa, that's really expensive. There's some sticker shock with that pricing. So I'll put you on the spot again. How would you think about the cost of capital for mezz, given that pricing?
It wouldn't be a factual statement if I said I've never come across the sticker shock reaction. Going back to where it fits in the capital structure, you've got senior lenders up top. They've got first claim on assets. They're going to charge a little bit less as a result of that. And so, hypothetically speaking, rates could be anywhere between 6 to 9%. The other end of the financing spectrum is someone goes to an equity provider. That equity provider is going to be looking for 20% plus returns. And so when you think about the mezz rates being between 10 to 14, that sort of falls in between. But at the same time, you're not diluting your equity base. And so it is more expensive than senior lenders, but there's a lot of value, there's a lot of flexibility that comes with that, and it's ultimately much cheaper than the equity raise alternative.
So be careful there, because you guys, the next thing we're going to go to is equity, and BMO Capital Partners also provides equity. So can you talk a little bit to when and why you would look at bringing equity in, and the types of different types of equity investors that are out there?
Yeah, maybe I'll start with the second part of the question in terms of the different pools of equity investors out there. The most sort of commonly sort of thought of are private equity firms, and so these are investors that are coming in, they're taking control positions, they're looking at 5 to 7 year hold periods before they exit. And the way that they sort of extract value, or their focus areas, is operational improvements, focus on leverage, focus on exit strategies. The second sort of pool of capital that is quite common would be strategic investors. So these are maybe businesses within the industries that are looking to acquire another business in order to access customers, in order to gain market share or new distribution channels. Sometimes they'll also identify savings efficiencies in terms of packaging up a bunch of competitors together. And these folks, they typically will have a longer sort of term hold of the business. I'd say the third pool of capital would be family offices. And these are investment arms of wealthy families, maybe families that have had a liquidity event along the way, sold a business, have a bunch of capital, or successful entrepreneurs that just have a lot of capital looking to diversify sort of their investment base. These tend to be minority or in some cases controlled investors, but they tend to be a lot better aligned with employee-owned businesses. They're really focused on legacy, they're focused on stability, and so we see that to be sometimes a good fit as well. The fourth bucket I think that I would speak on would be government-backed equity sources. And so these are some of the crown corporations that are floating around out there. They tend to be minority investors, and they tend to also have specific mandates in terms of how they invest their capital. And so they might be investing specifically on certain industries. They might be investing to support certain stages, life stages, early stage companies as an example. And so I think I mentioned they typically are minority investors. And so where BMO Capital Partners fits in on the equity investment perspective is we're minority investors with a long-term sort of time horizon, which we think supports shareholder growth and dovetails well with sort of the philosophy of employee-owned businesses.
Perfect, thanks. And that I think is the most important part when it comes to equities. Touched on two elements. One being the nature. Is this a control investor, or is this a majority, or is this a minority investor? And what's the time horizon? And tomorrow, I think you're going to hear from some other folks that are investing in equity alongside employee ownership transactions as well, where those dimensions work, right? Minority investors that have long-term time horizons, because most of the equity investors out there, they're looking for control, and they're looking to sell in 5 to 7 years. That isn't really aligned with most employee-owned companies. And so a really important part to be thinking about as you're figuring out who are potential capital partners are those two elements. Yeah. Okay, so we're going to shift to Dennis. And so far, we've been talking about employee ownership financing on the company's balance sheet, right? And that's not the only way that this can be done. You can also finance employees directly to purchase shares in the company. Different risks, different structures, and Dennis, it'd be great if you can talk us through what those are.
Yeah, absolutely. Some of you might be familiar with a few of the things that they spoke about, maybe all of them, but I'm going to start by talking about something that I think everyone's familiar with here, and then I'm just going to complicate it a little bit. First off, you need a loan to buy into a business. You go into a bank, you provide some assets, you get some debt from them, you're approved on your own merit, you take that money, you invest it in the shares of a company, and you buy it, right? I'm pretty sure everybody would understand how that functions. You're effectively taking the liability on yourself, but there's a benefit to the business as well because it's not showing up on their balance sheet, that debt, and it's something we'll come back to in a little bit too. I think everybody is familiar with how that works. You're getting approved on your own merit. The pricing will be dependent upon the assets that you're utilizing there, as well as your credit bureau score, everything like that. That's one step that you can do that. The other thing, in complicating it a little bit, is you also have an opportunity in working with a private wealth group at a bank, as well as with the commercial side of a bank, to do something similar but slightly different. So you would still go in and you would have the ability to be approved for a loan that would be in your own name, but in an agreement with the business and the commercial bank of the same institution, there would be a letter of comfort that would be provided that would enable the liability to still fall on the individual but be supported by the business itself. There's a contingent liability that would exist in the business to support the individual. Now, what's helpful for the individuals is that if something was to happen and they weren't able to pay the loan, the business would then be able to pay the loan for the individual to clear that up. Now, at the same time, that would be in an active default. At the same time, the payments for the actual individual to pay the loans would be designed to be occurring at the same time that the dividends of payments are coming from the business to the individual. So you structure it in a way where the person is still liable and paying for it, but the business is assisting and providing comfort in case something is to happen. So there's a way to tie it back together where both are still in it, and there's benefits again with it not being on the balance sheet and instead being a contingent liability, But you're sharing in that in the sense that both are together for both the debt as well as the opportunity for the growth of the business, okay? On that note, those types of products are not something you can walk into a branch and get. Let me just make that clear. I commented earlier, the first one you can. Those ones are ones that you would have to discuss with the business itself. If you're someone who's looking to get involved or a business owner who's looking to have this done, you would talk to your commercial bank, whoever that is, discuss the opportunities to utilize this. You would be approved based off the merit of the business, okay, for that contingent line. And then the individuals would be approved based on a number of factors. One, their own position, okay? So some of the stuff is going to be involved based off of their own ability to carry that debt, and they will still carry that on their own credit bureau. So it's not going to be, the business doesn't have a credit bureau, but it's going to be on their credit bureau specifically. At the same time, dependent upon how their tenure, the type of position that they're in, anything like that, will determine the length of the amortization, and in some cases, the actual interest that they pay. But the interest is going to be similar to the term loan interest that was mentioned by Devin. And so it will be a little bit different than on the personal side. So again, it's helpful because it helps structure things in a way that kind of mixes between personal and the commercial end of things, and is an opportunity for the business, again, to not actually have that on their balance sheet in its entirety.
So this is great. This is, I think what you said there last is really why companies will look at this. It's to keep the balance sheet clean so you can continue to invest in growth. You're not restricted in that way while still making this more accessible for employees, right? Where they're able to leverage some element of the company to borrow more than they may otherwise be able to. But they are taking a significant risk, right? And that risk is being shifted from the company to the employee. And so it'd be great if you could talk a little bit about that, what advice you would have for companies and for employees as they're thinking about the risk of borrowing directly to purchase shares.
Yeah, so I think on that note, we'll talk about it as an individual first. So if you're an individual looking at getting involved in buying into a business that you're an employee in, you really want to make sure that you understand what the business is, how it functions, make sure you've taken a look at the financials, maybe had someone else that you consider to be an advisor that knows a lot about the financial side of things reviewing it, because you have to think of this as an individual, as an investment. It's an investment that you're making in the business and in your future, just like any other kind of investment. So you want to ensure that, one, you understand the risks that are associated, you understand what you're looking for in the long term, and that it meets what your risk tolerance is. You don't want, as an example, this should be something that makes sense for you to invest into, but it shouldn't be absolutely everything unless you are involved with the business, confident you've been there for a long time. You have to make sure you're balancing all those things. For the business itself, Taylor just mentioned that there's the advantage of, in situations where maybe there's more economic uncertainty, doing things like this can add resiliency to the business because it's technically not debt that the business has specifically taken on, unless there's an issue with an active default in which the contingency line would then be utilized to pay the debt.
So I'm going to add one more question for you about, or maybe I'll just make a comment, which is the other thing that's important to know in an employee ownership context when you're doing this is that you're buying shares in a company that isn't trading. It's an illiquid asset, right? And so your time horizon, when you're looking to get that back, is a really important part to consider. We've seen situations in the past where employees invest a bunch of money and life event comes up, maybe they want to buy a house, they say, okay, I need to sell my shares now, and they can't do that, right? And so upfront education on that is another really important part, because this is not like investing in the stock market. This is in a liquid asset inside of a private company. Yeah. Okay, so one comment before I shift gears in a second. We've left out of this conversation so far a discussion on vendor financing. That's another really important financing tool in an employee ownership context. It's the most flexible tool. It can be the lowest cost. It can be the highest cost. It really depends on the seller's objectives. But you could create a vendor note that could combine features of all of these things we're talking about. And so that's something, if we want to talk about it in the Q&A, we can do, but just something we've left out of scope for now. Now, shifting gears, I'm going to come back to you, Devin. One of the things we find in talking to clients about this is there's two competing objectives. On the one hand, they want to maximize what liquidity they can get because this is in a succession context, this is ultimately their exit plan. On the other hand, they want to make sure that the company is not overburdened, right? And that it can continue to invest, it can continue to grow, it can continue to distribute money to its shareholders. And reconciling that is very challenging. And so I'll start with you, Devin, in terms of just asking, what advice would you have for business owners and executives in particular as they're navigating that tension?
Yeah, perfect. Thanks, Taylor. So really, this is a really important question in the context of employee sale. And the real reason for that is with respect to an employee sale, there is almost always a large portion of vendor financing that Taylor highlighted earlier. And so a typical capital structure that we can see with employee sales will be a portion of term loan, then maybe a subsection of mezz debt that Hans had chatted about, and then there'll often be a significant portion of vendor financing. So ultimately, the selling business owner's complete and total liquidity event is really going to be tied to the ongoing financial health of that business. So my advice to business owners would be that if you see value in an employee sale, that you need to understand that you're going to have more patience than you would when you're looking at a traditional sale. So ultimately, it's being patient with respect to preserving your legacy in employee sale.
And do you find there are some situations where maybe you mentioned some numbers earlier, 2.5 to 3.5 times EBITDA as potential financing you could get? Do you often come across clients that take less than that? And if so, what are the reasons why? What would be some reasons why they would say, I'm actually not going to borrow as much as I possibly can for this transaction?
Yeah, I mean, it kind of dovetails to the previous point I had. If you have a business that is extremely capital intensive, or you've got large growth objectives, looking at a lower level of leverage is going to allow the business to have that much more flexibility with respect to its sales and its management team to be able to potentially navigate more difficult, financial situations on a go-forward basis, and have that yourself as a seller, provide a little bit more flexibility and patience with respect to your employees involved in that.
Perfect, thank you. And so, anything to add? We're good? Yeah. Okay, so if you make the choice to borrow less upfront for an employee ownership transaction, it doesn't mean you've closed the door on future financing events. In fact, we see it's very common that companies that go down the employee ownership route have multiple financing events. We call them recapitalizations. So, Devin, can you talk a little bit about what recapitalizations are, when they happen, how they're structured, so people can be keeping that in mind as they're thinking about the evolution of an employee ownership company?
Yeah, absolutely. So recapitalizations is essentially a strategy where a company looks to sit down and rebalance their capital structure with that mix of debt and equity. So typically with respect to an employee share sale, this is something that's done 2 or 3 years after that is first set in place. And really what this provides is an additional and a liquidity event at a time in the future. And ultimately, this allows that owner to potentially refinance that VTB or that vendor financing portion that we had talked about with an additional term loan at a date in the future. So ultimately, what this accomplishes for the business owner is, a potential additional partial sale without a liquidity event. So it allows them to take additional chips off the table. It allows them to further complete that succession planning with respect to their business and employee share sale. It allows them to, again, diversify some of that wealth that they have that maybe continue to tie up in the business that they've sold. And it also has some tax efficiency with respect to that sale on a go-forward basis. But again, that's really something that can only be considered 2 or 3 years down the road once that business has de-levered as a result of kind of the amortizing feature of the term loans that we discussed.
Great, thank you. Hans, financing, as I think has maybe become clear in this session, is not off the shelf, right? There are many different ways each of these products are structured. I'm curious what advice you would have for companies as they're going to market to secure both the best financing terms and the best financing solution for their transaction.
Yeah, I would even take a step back before that point where they're going to market. I would actually encourage folks to start developing relationships with potential vendors early on. when you don't necessarily need the financing, because this allows the lender or the investor to start to get to know the story, start to establish credibility from your perspective. You get to really sort of control the narrative. You get to be the advocate for your business. You know the business the best, and you can start to set that tone. And so by the time you do go to market, who knows, maybe 6 months, 12 months, 2 years down the road, there's already a pretty solid understanding of the business. And so, from our perspective as an example, we oftentimes have much stronger success talking with our investment committees when we can confidently say, we know this business, we've been tracking their story for a couple of years now, they've delivered what they've always represented that they would do. It just makes that story a lot more compelling. When you do go to market, one thing that's helpful is to talk to multiple lenders and start benchmarking prices, benchmark terms, get to know what is good out there. When you're having those conversations with the lenders, be very transparent in terms of your financials. Lenders typically don't like to be surprised when there's a miss, especially right after close. And so being realistic in terms of what's coming down the pipeline is oftentimes quite helpful as well. I'd also encourage folks to sensitize their forecast numbers under different operating assumptions, interest rate assumptions, because the lender will be doing the exact same thing as well. And so to be sort of ready for those conversations, it makes a big difference. Once you've chosen a lender and you're negotiating some of the terms, think through what covenants are the priority items in order to allow for the most flexibility for reinvestment to drive growth initiatives. You may not get everything you want, but if you sort of identify what's important for you amongst a list of terms that are being negotiated, you'll just be that much more focused in terms of getting what you want and setting up the business for success.
Okay, so one of the things you mentioned there was talking to your bank early. And sometimes, I've heard feedback from people that, I don't want to go to my bank too early until I have everything buttoned up. And it looks great, so I'm coming from a position of strength and everything goes smoothly. And maybe you can pull the curtain back a little bit on what happens at the bank and why it's okay to come early and why you might not want to have to wait till the last minute when you got everything lined up.
Yeah, one thing that's quite helpful, I think for most lenders is when an opportunity comes in to potentially deploy a loan or mezz debt or maybe an equity investment, there's multiple conversation points that are happening behind the scenes. And so it's not a one shot, I need to have all the information all at once. Oftentimes even our internal conversations are that we have this opportunity to support this business. There's still some diligence points to work through, but it's the exact same thing on our perspective. And so even if a business owner doesn't necessarily have all their ducks in a row, so long as they have a general framework, the bank can start working with that. And the other positive thing about sort of that approach in terms of getting in front of a lender or investor early is that if you don't have all your ducks in a row, they might be able to provide some perspective and some advice as you look to fill in the gap, and that might actually optimize the end outcome as well.
Anything, Dennis, anything to add to that? No? Okay. Okay, so, right now we're operating in a pretty challenging economic environment. We came out of COVID and inflation, and then we had rising interest rates, and now tariffs, and there's a lot of uncertainty. And so curious how you're seeing, capital providers in each of your areas responding to this environment. How are you approaching it differently, either in the way you're structuring your loans or in the way you're diligencing companies you're working with?
Yeah, I can start with that. So, all lenders really continue to support Canadian entrepreneurs who operate on both sides of the border. Now, it's no surprise that during the interest rate run-up that occurred post-COVID, that really reduced borrowing capacity in the marketplace. Now, Thankfully, what we've seen over the last 18 months and what is projected to continue into 2026 is that interest rates have now started to come down relatively quickly and substantially, with potentially another 25 basis point interest rate decrease coming up next week. So that's really welcome news for borrowers as well as for lenders, given where we want to be active in the marketplace. Now, on the inflation front, really what we're seeing from clients is inflation is something that none of us have been able to escape, whether we're operators or individual consumers. But business owners have been able and willing to pass on those costs to consumers, and the consumer, at least up until this point, seems to be accepting those price increases, which is again, good for the economy and good for our businesses. Now, with respect to some of the trade wars and the tariffs that are currently happening around the world, and frankly with our largest trading partner, we're seeing a lot of kind of indication with respect to that economic disruption, but a lot of our clients have not yet seen direct economic impact from that. But I would say it is coming. So I'd say that there's two pieces that are emerging from a lenders, is that we're wanting to have a lot more regular, in-depth discussions with clients around how they're being impacted, how their customers are being impacted, and what their plans are with respect to that. Now, internally as lenders, we're having very regular conversations with respect to what clients are seeing in the marketplace and how we continue to support the clients that we're looking to work with. The second piece that we're looking at seeing is really greater partnership from organizations like Export Development Canada in two fronts. The first front being there are insurance solutions that organizations like Export Development Canada offer that can help risk share with lenders to help provide some comfort in these uncertain economic times. The second piece would be clients looking at expanding into new markets and some of the advice and consultative approach that organizations like Export Development Canada can provide in doing so. So I would say those are two of the things that we're seeing emerge.
So before we go to Hans, I'm gonna put you on the spot one more time. So, tough environment. Are you seeing timelines being impacted for securing loans? What do you, from a process perspective, what should companies in this room be doing differently given this economic environment? Yeah,
I mean, absolutely we are. So what I would say is start that process earlier. Have those conversations well in advance, and to Hans's point, really be open and upfront with lenders with respect to financial challenges that you see, because there is a significantly higher level of due diligence placed on clients, especially clients that have exposure to U.S. markets, and the uncertainty with respect to that going forward. So timelines are prolonged, and so earlier conversations and engagement really needs to happen.
Okay, thank you. And Hans, over to you.
Yeah, I would echo that from a debt perspective. I mean, we're seeing lenders tighten up their covenants, maybe not being being a little bit more disciplined in terms of how much money they want to lend out. And certainly the diligence cycle is taking a lot longer as well. And that extends over to the equity side as well. We're seeing a lot of timelines get stretched out. Diligence cycles go longer, more and more rounds of diligence happening to really have the investor get comfortable with the potential investee. And so that's a trend that we've really seen over the past, call it 9 months or so. I'd say from an equity perspective, the other thing that we've really noticed is that given all the uncertainty and the macro headwinds that have happened the past year, there's been a bit of a dislocation in terms of valuation. And so you've got sellers, business owners who continue to believe their business is valued at X, and then you've got potential buyers who find it tough to price in the impact of all the noise happening, and so they're valuing the business lower at Y. And so we're seeing more and more structure to get those deals done. And so examples of that to protect some of the downside risk is investors might be investing by way of preferred share classes, so it's a bit higher ranking. They might structure certain terms that allow them to recoup their capital first, or minimum return hurdles before the rest of the equity equity holders get their money out the door. And we also see sellers who may not necessarily like those terms, they're holding the assets longer as well. All around, I think everyone is adapting to the new normal, I guess.
Yeah, I would love to say that in the private wealth market we haven't seen that at all, but we've seen the same thing. Timelines have been extended, diligence has increased. What I would say as well is to reiterate some of the points that were made. Forecasting out for the future is incredibly important, ensuring that you're doing it and it's meeting what your goals look like in the short term and the long run. Building that resiliency into your forecasting is going to help you kind of decide what does your debt to equity sizable look like here, and using the different opportunities that exist from a debt perspective we've discussed today to help you build that resiliency into those forecasts. I'd also say that, and as an example, with interest rate rising environments, some of the stuff we've talked about with term loans, they're going to be susceptible to an increase in interest rates, right? Whereas equity gives you a bit more of a cushion on that. And so thinking about where the debt position looks like for your business going forward and forecasting that in to decide what it looks like, then engaging your bankers early is really, really important. Been doing this for a long time, and I'd say that right now, engaging with your bankers early and being very upfront and coming, not fully prepared as Hans said, but prepared enough is really important to keep things moving faster and trying to reduce that overall timeline that things have been pushed out on right now.
Great, thank you. So, in this environment with the uncertainty, you've each talked about the different structures that you invest through. What are the levers that companies can pull right now to enhance their resilience in this environment?
Yeah, so that's a great question. I know I just kind of led into that a little bit there because it was kind of flowing in the conversation, but in all reality, the levers that you have are any of the conversation points that we brought up here today, the different product types. Each of them has different advantages and disadvantages. We talked about term loans. Term loans are great, they can be cheaper, but they're subject to interest rate risk. Okay, so a lot of people saw that. I think during a thing called COVID, interest rates went up for a little bit there and then dropped back down. There are outside market events that can occur that can change the interest rates. We've seen over the past few years they've gone down. We're talking about variable rates as well as fixed. Those can shift in those. With equity, we have the ability to build in a bit of a cushion when it comes to that because you're not susceptible to the same type of repayment structure. But again, those have their other pieces that Hans talked about here about sharing in that kind of growth of the business itself. So what you want to do to add resiliency is balance what your debt and equity positions look like and match that to what you're forecasting out for the future to try and assist with your ability to manage through uncertain times.
Yeah, and maybe I'll add on. I think in this environment, when it comes to an employee ownership transaction, we are seeing folks take a longer term time horizon, right? Because you could still try to, do an EOT transaction with the goal of exiting in 5 years, which is aggressive in even the best environments. But if you really want to ensure success, right? Extending that out, being ready for that is really one of the few options that you have and something to be thinking about. I want to get to Q&A, and so just to wrap up, this is I think we did it. We got through all the products and at a decent level, and so and we these are applicable across the various structures. So thanks to all of you. Again, I want to hammer home the message on why consider financing, and it really is to accelerate that transition to employee ownership in a way that is accessible, right? That's why you use financing. You don't have to use financing. Their vendor notes can be great as well, but this is an important piece to it. It's more than just the liquidity. There's a lot of benefits that can come from that. And so, just to wrap up before Q&A, it'd be great to get just some final thoughts from each of you on, from this session and your advice to the folks in the room that are thinking about employee ownership and what financing might be available. We'll go on the opposite side. We'll start with you, Dennis. Yeah.
Perfect. I think final thoughts for myself is there's lots of opportunity that exists out there as options for debt. So I think each and every one of you needs to look at what options are available. We brought up, Taylor said all, but I know we just covered a basis of them, right? Like we're trying to give a good idea of it, but take your time to look into that, research what options are available, reach out to a banker or an advisor that you have where you can get an idea of some of those options that are there. Looking at the options and deciding what is right for you, managing all of the risks, the positives, the negatives, the risks, the positives, Look at all of that and decide what is right for yourself and the business, and then make your decision from there based off of ensuring you forecast out for the future to build in that resiliency.
Thank you. Hans?
Yeah, from a junior debt perspective, I mean, I'd say consider that as an option. It's a very bespoke, tailored sort of product, and it can be highly structured based on the priorities of the business owner. And from an equity perspective, consider having that minority equity that is like-minded and dovetails well with the general philosophy of employee-owned businesses, which is to drive that stability, create that legacy, and ultimately have a partner that is not going to be making really short-term decisions to drive sales growth at the expense of longer-term, broader shareholder growth. And so a lot of different options, and we're always happy to chat.
Perfect, thank you. So the last piece I would say is that employee sales are not new, but employee ownership trusts are, and I think it does offer a valuable and attractive solution to some business owners. What I would say with respect to that, and I hate to beat a dead horse, but you really do need to have really early conversations on these topics because it is so new in the marketplace. And lastly, really as lenders, we are meant to work alongside the accounting and legal professionals and other consultants that you currently work with. We are not to replace them. We are kind of adding additional bench strength to the existing professionals that you're working with. So yeah, early and in-depth conversations are extremely important.
Perfect. Well, thank you so much. And I think we've got a decent amount of time for some questions. You say 2 minutes? Well, I got that wrong. Okay, my bad. I see one, Pete. Yeah.
Thanks. Just context in the room, I'm a recovering banker myself. So I know, again, pulling back the curtain a little bit, when it comes time to actually making the decision on a credit, a lot of the people who are in the credit risk department and are charged with making that decision, they get judged from a regulatory standpoint and like, how well can they justify to someone who's picking it up cold why they made the decision they made? And so back to your earlier comments on, engaging early, but being able to tell the story of whatever's happening in this transaction to defend the decision. What are you guys seeing in terms of how much of that defense of the story is just the straight spreadsheet numbers on a page versus some of the more qualitative parts of the story, like the strategy, the market positioning, tariffs, all that kind of thing?
Yeah, I can absolutely help answer that. So first off, great question. What I would say is that, when you're sitting down with lenders, whether that be, what we would call the incumbent or the existing relationship that you have or new relationships that you're looking at, if that conversation is simply, send me the last 3 years of your financial statements, a 24-month pro forma forecast and your, aged accounts receivable and payables and inventory listing, and that's really where the conversation ends, you're not working with the right partner. You need to be sitting down with an individual that's asking those quantitative questions in addition to qualitative questions to really understand what your strategies are, who the key employees are, who key customers are, who key suppliers are, and really what you're doing to defend against some of the economic headwinds that we're all seeing. So again, if you're not asking those questions, then you're not sitting down with the right partners.
I'll jump in quickly there. Again, good question, obviously a banker, or an ex-banker, sorry. The financial statements, to your point, like the financials themselves, that is like the outline of a story, okay? The qualitative part that you're talking about, that's the whole story. So when we talk about the outline being the financials, we could read the outline, but we don't understand the full story. We have to read the full story to actually be able to piece everything together. And so to your point, and to Devin's point, taking the outline's great, having the full story actually puts it all together. So the qualitative part is what helps us understand the entire story. Make sense?
I'll just add one last thing here, which is that, each of these individuals, when and anyone at any other bank in their roles, you're going to work with them, and then they're going to go to a credit department who's there to manage risk to make the case for why they want to do this loan, right? Like they're the one pitching it on your behalf. So they need to be equipped with all of those details. They need to be capable of being there to make the case for why this makes sense, why this is a good deal for the bank. So keep that context in mind as you're preparing to go to your bank and working with them through this process. So sorry we didn't have time for more Q&A. We will be here for the whole conference, so I promise instead, if any of you want to chat, ask questions, we'll be around. So thank you.